This presentation shows the financial analysis leading to the lease versus buy decision. I'm Pat Obi, Professor of Finance at Purdue University, Calumet. In a leasing contract, the lessee is the party wishing to borrow the equipment, as illustrated right here. The lessor, on the other hand, is the lending party. And so the equipment will transfer from the lessor to the lessee. For the lease, or for the lessee rather, this is a financing decision. Obviously, in a previous capital budgeting analysis, the lessee here must have determined that investing in the equipment will add value to the firm. In other words, the equipment has a positive net present value. The question now is, which method of financing the use of it is cheaper? Is it cheaper to take out a loan and buy this equipment? Or is it cheaper to lease it, as is being considered here? Now keep in mind, the question before the lessee is not whether to use equity dollars to purchase this equipment or leasing it. We cannot compare the use of equity dollars to make a purchase to leasing the equipment because the two are actually diametrically different. If you use your equity to make a purchase, the equipment belongs to you. It conveys ownership rights. If on the other hand you lease the equipment, you don't own it. At some point you're going to have to return the equipment. And so the comparison here is between leasing this equipment and taking out a loan to acquire it, to buy it, because neither of the two alternative financing methods will convey ownership to the lessee. In fact, the lessee would not have title to this equipment until A, the loan has been paid off if a loan were taken out, or B, the lease has expired and the lessee chooses to go ahead and buy out this equipment. And so, as we can see in this regard, the comparison here is taking out a loan to buy the equipment versus leasing it. Which method is less expensive? And in this context, leasing is therefore viewed as an alternative to borrowing and buying an equipment. Both contracts call for fixed payments, interest charges in the case of a loan, and lease payments in the case of a lease. Also, both financing expenses are tax deductible. Interest charges on a loan are tax deductible as well. Lease payments on a lease contract are also tax deductible. And so for this reason, the after-tax cost of debt becomes the appropriate discount rate that we're going to use in determining the net present value of the cost of taking out a lease as well as the cost of taking out a loan to make this acquisition. The lessor, on the other hand, is in the business of leasing out equipment to individuals and businesses wishing to rent them. As such, for the lessor, the financial analysis here is an investment decision. It is not a financing decision, as was the case of the lessee here. For the lessor, it's an investment decision. The lessor will be willing to lease out this equipment if doing so will result in a positive net present value, as we learned in capital budgeting. And so for good measure, the lessor's investment analysis is included in this presentation. Now, I have provided you with additional reads here. For example, here I summarize the four key types of leases. The two most important are capital lease, which is also called financial lease, and operating lease, which is also called service lease. And then right here, I write a little bit more about capital lease based on the tax guidelines in the United States. And then right over here, I give a summary of the 5 points that make leasing an alternative to taking out a loan and therefore the reason based upon which the after-tax cost of debt becomes the effective discount rate that we're going to use in finding the net present value of the cost of leasing as well as the cost of borrowing to buy the equipment. So now here's the mini case that we're about to consider now. You can read it on your own. It starts from here, continues, and right here is the summary as presented on a spreadsheet, which I'll go into shortly. This is an equipment costing $100,000, which also is the depreciable basis. The depreciation term would be 4 years, and it's going to be fully depreciated over that period. So as you would imagine, if you're depreciating $100,000 over 4 years, down to 0 divided by 4 will fetch you $25,000 in depreciation expenses each year. Now though, in this case, this company plans to use it for only 3 years, not for 4. At the end of 3 years, the equipment can be sold in the market. It is projected at $30,000. The weighted average cost of capital that we're going to use to discount cash flows for the lessor when we're doing investment analysis would be 8%. Tax rate for both lessee and lessor, as I show here, is 20%. Continuing now, thinking about the lessee, if that individual were to borrow to purchase this equipment, the loan would be for the full amount of $100,000. Costing 11.5%. The after-tax cost is 9.2%. Formula shown here. Again, the loan would be for a period of 3 years, since that's the length of time that the lessee plans to use the equipment. At the end of 3 years, the lessee expects to sell it rather for $30,000. Now though, at that time, the book value of this equipment would still be $25,000. Remember, the equipment wouldn't be fully depreciated until after 4 years. So in the third year, as I'm going to show shortly, the book value of the equipment would still be $25,000. Maintenance expenses per year would be $3,000. Now, if on the other hand, the lessee were to go ahead and lease the equipment, again, the lease term would be 3 years. And this is going to be the annual lease payments. However, there's going to be a down payment on the lease in the amount of $13,500. In this example, there aren't going to be any other expenses. There wouldn't be a buyout option. That's why I wrote no here, meaning that at the end of 3 years of lease, the lessee will return the equipment. It does not plan to pay money to buy it out so as to keep using it. There are no maintenance expenses. Those already have been rolled into lease payments. However, again, residual value that will be considered at the end of 3 years is $30,000. The term residual value is analogous to market value. So using the straight line method, this is the depreciation calculation. It's the depreciable basis minus the ending book balance, which of course is 0. And then you divide that by the economic life, and that's how we got the $25,000. And this is the depreciation schedule. I kind of color coded it so you know that the $25,000 shown here per year represents the our tax deductible expenses. Now likewise, I show the loan amortization schedule. If this firm were to take out a loan and acquire this equipment, the loan would be amortized over 3 years, and the amortized payment per year is shown here to be $41,277.64 each year. However, the interest component, which is tax deductible, is shown here. The remaining amount within this annual payment are principal repayments. These are not going to be tax deductible, but they do represent cash outflows though. So let's go to the spreadsheet and I'll show the analysis proper. So right here is the spreadsheet analysis. This is the general information we already have looked at. This is the borrow to buy option input data, and this is the lease option input data. This is the depreciation schedule, which I've already shown, and this is the loan amortization schedule, which also I have shown. To calculate the annual payment, it'll be the PMT function equal PMT, open parenthesis, it prompts you for the interest rate. For that, I go up here to the input section and I click on this cell containing 11.5% interest rate, scroll down, comma, it prompts me for a number of periods, and I go back up here, I click on this cell containing 3 years, I scroll down, and then comma, it prompts me for the present value of the loan. I hit a negative before I reference it. Why, you ask? Well, so that my results will be positive. That's really the reason. So now the other commands are unnecessary, are not considered in this case. All right, but that's it right there. That's the loan amortized payment right there. Okay, so now here's the lessees analysis. First, suppose the lessee were to choose to borrow and then purchase this equipment. Notice the maintenance expenses that will have to be paid each year, the interest payments from the loan amortization schedule, and the depreciation expenses. Now, notice how I referenced these cells with a negative. For example, here I would hit negative instead of equal. And I would go up here for the maintenance expenses and I would click on this amount right there and I hit enter, and likewise I do all of these. So that's how I reference the interest payments, which I get them from here, from the loan amortization schedule, depreciation expenses from the depreciation schedule right there, and then you add them up, figure out the tax effect. The tax effect, if I were to go there, again, you want to use negative to reference the tax rate cell. You go up here to the inputs, you click right here on the tax rate cell, multiplied by, scroll down here, and click on the cell right above it. All right, now because I used a negative to reference the tax rate cell, as I'm showing right up here, when you multiply the negative tax rate cell by this negative amount here, it returns obviously a tax credit. So if this amount had been positive, say for example $40,000, something like that, then this would be a negative cash flow because it represents a tax liability undue. Alright, so these are all tax credits associated with these cumulative expenses, all of which are tax deductible. And then you figure out the net of these two values to get the net income. You add back depreciation, which would be, if I delete that, equal this net income here plus the depreciation for the first year. All right, so that's how you get that. We add back depreciation because depreciation is a non-cash charge. And then these are the loan repayments, which you reference from right over here. And then this is the loan amounts that you took out from a bank. It's a cash inflow, and then you spend it purchasing the equipment. So it really is a wash. You don't have to put it there, but I leave it there anyways just for the fun of it. So now, sale of equipment at the end of 3 years. Remember, this company wishes to use this equipment for only 3 years. So at the end of 3 years, the company expects to sell it for 30 grand, and this is the tax consequence of doing so because you plan to sell it for 30. However, if I scroll up here, at the end of 3 years, the book balance is 25,000. So 30,000, if I go up here, which is how much you expect to sell it for, minus $25,000, the book value is 5,000 multiplied by tax rate of 20%. That'll fetch you the $1,000 that would represent the tax liability on the sale. Now then, use the NPV function equal NPV open parenthesis, reference the tax rate, which would be the discount rate here. In this case, it'll be the after-tax cost of debt, as already explained. You hit equal, and then you'd have to come here. Notice it says from value number 1. You start from here, first year to the last, close parenthesis, and then you subtract the initial cash flow, which is this. It's already 0, so it doesn't really matter. All right, and that's how you get that. What this says is that if you were to take out a loan and make this purchase, the net present value of the cost of doing so is $71,171.52. If, on the other hand, you choose to lease, given the down payments today at time period 0 and the subsequent lease payments, figuring out the tax effects, and noting that there is not going to be any additional cash flow in the third and final year since you will not be exercising the buyout option, the NPV would be 70,124.48. That's the net present value of the cost of leasing. Now this buyout option here shows as 0. Now if you notice, I kind of used a little bit of an interesting if statement right here to execute this task. You don't have to do that, but it makes your spreadsheet even more global. For example, this says that if that cell in the input says no, then you should have 0 right here, meaning that the lessee rather, would no longer be spending money to buy out this equipment. Otherwise, if it doesn't say no, then it will be assumed that the lessee will pay an amount equal to the amount in cell B33, which is that residual value of $30,000. So if I were to scroll up here and I change this argument here from no to yes, meaning that yes, at the end of 3 years, the lessee plans to spend $30,000 to buy this equipment so as to keep using it. You come down here, you see it's shown here under the buyout option under in the lease analysis. So now the net present value of the cost of leasing would go up to $93,000 and change because this is an additional cash outflow. Now, also what that means is if this lessee would be using this equipment beyond 3 years, then if you were to purchase the equipment in the first instance, it would not have to be selling it in the 3rd year. So as you can see, this automatically returns 0 because the lessee would no longer be wanting to sell the equipment 3 years from now. There wouldn't be any cash flow here and there wouldn't be any tax effects as a result. Again, because I used the if statement to execute this command. Again, no need to do so, but if you can figure it out, it makes your spreadsheet analysis even more pleasant and enjoyable. So I'm going to hit undo because again the command here is no. So with that, come down here. The net advantage to leasing is 1,047 because it means that the cost of leasing is less than the cost of buying up here by 1,047. Question: what would be the lease payment that will cause the cost of leasing to be equal to the cost of buying so that the net advantage to leasing is 0? The answer can be found quite easily by going to data and going to what if and choosing goal seek. So you want to set the cell containing the difference, the net advantage to leasing, to click here a value of 0 by click here by changing the input cell which contains the lease payment. So OK and OK, and that comes out to be 29,918.89. If I scroll down, you will see that that'll cause the cost of leasing to be identical to the cost of buying so that the net advantage to leasing would be 0. Now what this means, if I hit undo, I've already written it out here for you. What this means is if lease payment exceeds 29,918.89, NPV cost of leasing will no longer be less than the cost of taking out a loan to buy the equipment. However, if the lease payment is less than this amount, which it is, as you can see up here, it is only 29,400. And so if it is less than the break-even right here, then the cost of leasing would be less, and therefore there would be a net benefit to choosing to lease instead of borrowing to buy. For the lessor, it's an investment analysis. The lessor gets to receive the down payment and the annual lease payments. However, the lessor gets to pay for expenses since it's already been rolled into the lease payments, as well that the lessee would pay. So also the lessor will recognize the depreciation expenses. Now don't be confused. Remember, depreciation expenses were only recognized for the lessee in the event, if I go up here, that the lessee buys the equipment. Then you can get these depreciation expenses. But if this company chooses to lease the equipment, as you can see down here, under lease there are no depreciation expenses because in this case the lessor will get to write that off in this particular lease arrangement. So sum up all these, net these cash flows, that's what you have. Recognize the tax effects, that's what you have. Taxes will be paid when money is made. And if money isn't made, then there will be tax credits. So in this case, if we go down here, this is the cost of the equipment at time period 1, because the lessor would have to shell out $100,000 to purchase the equipment before it can go ahead and lease it out. Now also 3 years from now, the lessor would either be receiving $30,000 from the lessee because the lessee chooses to keep it, or if the lessee returns it, the lessor can sell this in the open market for this projected amount of $30,000. And this is the tax associated with this disposition. So find the NPV. Again, NPV would be equal to, and I know I did it already, but I'm going to do it again just for a reason. First of all, the discount rate to use here is the weighted average cost of capital. So I'm going to go up here and click on this cell right here containing 8%. And then I scroll down, I hit comma, it prompts me for the cash flows, values from the first to the last. This is the first cash flow from year 1 to the last one. And then I close, and then I subtract the initial cost. So I'm going to subtract it using positive because this cell here is the cash outflow. If I hit minus here, it's going to counter this and then return a positive value, which we don't want. So that's part of the reason I had to do this again. So hit enter, and that's how you get the NPV. So as you can see, NPV is positive, therefore the lessor should go ahead and lease this equipment. Also IRR, which by the way uses the function IRR equal IRR open parenthesis. For IRR, just get all the values. In other words, get all of these like so, close parenthesis, and that's it. Now it's incorrectly formatted. So you want to go home, if you're not already there, and click %. And that's it right there. You can expand the decimals, and that's it. So be mindful of the formatting. Okay, so IRR is greater than the WACC, which is 8%. So either or, we should go ahead and lease and do this lease contract. Now, the break-even lease payment here is shown here to be $28,849. That'll be the lease payment that'll cause the NPV to be 0. So to calculate that, we would have to go to data again, what if, goal seek, set the NPV cell to be equal to 0 by changing. We go up here, click right there for the lease payment, OK and OK, and that's it here. 28,849, because if I go down, that rate would cause NPV to be 0, meaning that's it right here, meaning that if the lease payment is an amount greater than 28,849.52, it'll be a good deal for the lessor. Now fortunately it is, because it is actually 29,400, which is greater than this. So for any amount greater than this, it'll be a good deal for the lessor. Fortunately, this break-even for the lessor is lower than the break-even for the lessee. First, let me hit undo, because now what this means is that since the lessor's break-even is less than that of the lessee, the difference between these two values is the negotiation room. So that difference, if I may sit here, hit equal, click on this cell, minus this particular cell here, would give me 1,069. So that means as we increase the lease payment based on this negotiation room, but by no more than 1,069, we're still going to be able to make money for the lessee, sorry, for the lessor, and still keep the cost of leasing to be less than the cost of buying. So if it exceeds 29,918, it's all bad deal for the lessee, even though it's a good deal for the lessor. And of course, for the lessor, if we go below 28,849, it's all bad deal, very bad deal for the lessor. So fortunately, we do have a negotiation room between 29,918 and 28,849. So I think there's a high possibility that these two parties can make a pretty good deal, because right now, given the lease payment of 29,400, which as you can see is less than the break-even for the lessee and yet greater than the break-even for the lessor, the two parties will walk away from this deal with a smile on their face. And this concludes this presentation. I am Pat Obi, Professor of Finance, Purdue University, Calumet.